Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves, bringing you the market insights that matter, delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. So today was quite something, a really fascinating and frankly contradictory market day.
Definitely felt that way. You had these two really powerful, almost competing forces at play.
Exactly. On one hand, you had this sense of diplomatic relief, kind of lifting stocks, driving investor optimism.
Right.
But then clashing right against that, you had this major geopolitical disruption, just a violent repricing in commodities.
Yeah, it created this sort of odd regime, didn't it? Like a geopolitical risk on, but with this massive energy repricing happening simultaneously.
It's a paradox we should probably unpack.
Absolutely. It was one of those days where you had to, double check your screens. The market wasn't all moving together.
Not at all. Different assets seem to be reacting to completely separate news flows.
Almost like they were trading in, two different worlds.
Okay, so let's start with the positive side, the diplomatic angle. U.S. equities, they surged today, a clear sign of risk appetite, wouldn't you say?
Oh, absolutely. The S&P 500 put in a solid gain, 0.58%, closing up there at 6,738.44.
Okay.
But the real leader, the standout, was the NASDAQ composite. It really outperformed.
How much did it gain?
It jumped 0.89% to finish at 22,941.80. So quite a bit stronger.
And the Dow?
The Dow Jones Industrial Average also climbed, added about 144 points, so up 0.31%. Equities definitely signaling, calm, maybe even optimism.
Right. Now, contrast that relative calm with, the chaos in crude oil. The energy market felt like a full-blown shock event.
Shock is definitely the right word. We saw the largest single-day gains in crude oil since, mid-June?
Wow, that far back.
Yeah. Brent crude shot up a staggering 5.14% to $65.81.
5%.
And West Texas Intermediate, WTI, it surged almost 6%. 5.99% to close at $62.81. I mean, that is a massive, massive move for oil in just one session.
And we know the immediate triggers, right? For stocks, the strength seemed to come from that confirmation about the Trump-Xi meeting.
Exactly. Confirmation that President Trump will meet with Chinese President Xi Jinping next Thursday, October 30th, over in South Korea. That provided some immediate diplomatic relief.
Okay, and then the flip side. The oil driver.
That was a surprise announcement from Treasury. New sanctions, a major escalation targeting Russia's oil sector, specifically hitting Rosneft and Lukoil, two huge state companies.
Let's stick with the good news first, the diplomatic bit. That Trump-Xi meeting, the timing feels pretty critical here.
Oh, absolutely. We're just 1 week away from that November 1st deadline, the one tied to those threatened 100% tariffs if China keeps up its rare earth export curbs.
And isn't there another deadline looming too?
Right, the broader U.S.-China tariff truce, that's set to expire on November 10th. So yeah, the timing couldn't be more critical.
And historically, just the idea of a meeting can spark a rally.
It often does. Even just the prospect, sometimes even just a photo op, has been enough to trigger these relief rallies. And that really explains why the NASDAQ composite led the charge today.
Can you break that down a bit more? Why the NASDAQ specifically? What's the mechanism?
It really boils down to exposure. Technology shares just have the highest proportional exposure to China.
In what way?
Both in terms of supply chains, think about manufacturing components, chips, that sort of thing, and also as a huge export market for finished goods.
Got it.
So when trade tensions seem like they might ease, even temporarily, those stocks, names like NVIDIA, Broadcom, Amazon, they immediately benefit from that reduced headline risk.
Any specific examples today?
Oracle, for instance, jumped nearly 3%. That really reflects that direct sensitivity to trade news.
Okay, but here's a question. If this meeting is potentially such good news, why wasn't the reaction bigger? Why just measured gains, not something more euphoric, like a 2 or 3% pop in the indices?
Well, I think that goes back to the historical context, the fool me once kind of thing.
Yeah.
Market participants are cautious.
Learned from experience.
Exactly. They seem to be pricing in a modest probability of progress, not banking on certainty. They remember previous Trump-Xi meetings provided some temporary hope, sure, but substantive agreements often proved elusive or just fell apart quickly.
So this feels more like positioning Taking some risk off the table.
I think that's a good way to put it. Removing some downside risk rather than a full-blown conviction that a major deal is imminent.
Okay, so that covers the measured optimism in stocks. Now let's pivot hard to that other story, the geopolitical shock hitting commodities, those new Russia sanctions.
Yeah, this is a big deal. It represents the largest escalation against Russia's energy sector since the conflict in Ukraine really began.
And the stated goal.
Treasury Secretary Scott Bessent was pretty explicit. The goal is to force Russia to sell its oil at a massive discount, hurt the revenues that are funding the war.
And hitting Rosneft and Lukoil is key.
Critically important. Those two companies account for nearly half of Russia's total oil exports. So targeting them is really targeting the engine of their revenue.
And the market reaction, particularly from Russia's biggest customers, was immediate.
Instantaneous and pretty severe. We saw reports almost immediately that China's state oil giants, PetroChina, Sinopec, CNOOC, Zenhua Oil, were suspending purchases of seaborne Russian crude.
Why so fast?
They're citing compliance concerns. Basically, they're afraid of getting caught up in U.S. secondary sanctions running afoul of the financial system.
And the volumes here are significant.
Immense. China imported something like 2 million barrels per day of Russian oil just last month in September.
Wow.
So that immediate suspension, even if temporary, creates instant material tightness in the global supply picture. And that's really what drove that huge 5 to 6% price surge today.
Okay, so this brings us right back to that central paradox. The great divergence, as you called it. How can oil jump 6%, a genuine shock, while equity volatility measured by the VIX stays so low it closed around 18.60?
Yeah, pretty calm.
Shouldn't a massive spike in global energy costs cause at least some panic, some nervousness to creep into the stock market?
That really is the core question today, isn't it? Which market has it right? Is the commodity market right to panic about supply, or is the equity market right to sort of shrug it off?
The equity market's view seems to be...
It seems to be betting on the transitory nature of this disruption, that this won't last.
Okay, why would they think that? What are the reasons?
Well, there are probably three key reasons traders aren't pricing in disaster just yet.
Okay, let's hear them.
First, there's the sheer scale of the global oil surplus. It provides a pretty big cushion.
Right, we've talked about that before.
Yeah, the International Energy Agency, the IEA, they still expect world supply to exceed demand by almost 4 million barrels a day next year.
4 million barrels a day surplus.
That's the projection. So that supply abundance acts as a kind of natural ceiling on any sustained price increase. Today's jump feels tactical, maybe short covering, but the fundamental backdrop for oil still looks pretty bearish, frankly.
Okay, so reason one, fundamental oversupply buffers the shock. What's reason two for the calm VIX?
Reason two is that many analysts, and presumably traders, view these sanctions less as a permanent attempt to halt oil flow and more as a calculated negotiating tactic.
A bargaining chip.
Exactly. A massive piece of leverage for potential Ukraine peace talks down the road. If the market believes this move is temporary, something that could be reversed upon negotiation, then it doesn't warrant sustained panic or a big jump in the VIX.
Makes sense. And the third reason?
The third one is historical precedent. Maybe. Russia is, let's say, experienced in circumventing sanctions.
They've done it before.
They have. They've established shadow fleets, found alternative buyers, primarily India in recent times. So the current spike really relies on whether China and India truly halt purchases long-term or if they quickly develop workarounds.
So it's a bet on logistics and, well, finding ways around the rules.
It's a bet on logistical ingenuity, yeah. If those workarounds emerge quickly, today's price spike likely fades, or mean reverts, as they say. Hence, the low equity volatility.
That analysis flows really nicely into the fixed income world because obviously a 6% oil spike screams inflation concerns. How did the bond market react today, the inflation barometer?
Well, we saw the 10-year Treasury yield tick up a little. It rose 4 basis points, closing just under that key 4% level at 3.99%.
Okay, so a slight move up.
Right, and that reflects that internal tension we've been talking about. You've got inflation pressure from the oil spike pushing yields up slightly.
Yeah.
But the longer-term trend, the dominant trend, is still lower yields. The 10-year is still, 0.16 percentage points lower than it was just a month ago.
So that longer trend suggests the market is still really holding on to expectations for Fed rate cuts, right? Even with all the government shutdown noise complicating the data releases.
Absolutely. Despite those data gaps, the market consensus hasn't really budged much on the Fed's expected path.
What are the odds looking like?
Traders are still pricing in better than a 70% probability for 25 basis point cuts at both the upcoming October FOMC meeting and then again in December.
So the focus now shifts squarely to that delayed inflation number.
All eyes are now on Friday's delayed October CPI report. The expectation is for 3.1% year over year.
And if it comes in hotter?
If we see a reading hotter than that, maybe 3.3%, 3.4%, that could seriously reshape those December cut expectations, maybe even challenge the October one, though that seems less likely now.
Okay, let's shift gears slightly to credit markets. This continues to be a puzzle, doesn't it? You have high absolute yields, which look attractive on the surface.
Right. They do?
But then you have these credit spreads that are historically tight, which sounds incredibly risky. Can you unpack that idea of asymmetric risk in credit right now?
Yeah, happy to. Because this is where you can really see the market's underlying, maybe complacency, most clearly. So when we talk about credit spreads, we mean the extra yield you get paid over a risk-free treasury bond for taking on the risk that a company might default.
Okay.
Right now, investment-grade spreads are hovering around 77 basis points. That's near the tightest levels we've seen in like 15 years. High-yield spreads are also quite tight, near 348 basis points.
So if I'm understanding this right, the asymmetric risk part means while the total yield might look decent, say 5% for an IG bond.
Which sounds good in isolation.
Right, but the actual compensation you're getting specifically for taking the credit risk, the default risk, is minimal.
Precisely. You have very little room left for those spreads to tighten further, meaning your potential upside from spreads narrowing is limited.
But the downside.
But you have substantial downside risk if economic conditions worsen even slightly. Any real sign of recession, any uptick in default worries could cause those tight spreads to blow out, to widen dramatically.
So it signals a lot of confidence, maybe too much confidence, about the corporate outlook.
It signals enormous, perhaps undue complacency about corporate health right now, yeah.
Okay. And just quickly before we look ahead, anything unusual in gold today? It seemed to recover despite things that usually push it down.
Yeah, that was another little anomaly. Gold recovered almost 1%, up 0.98%, even though the dollar was stable, slightly up actually, and real yields were rising. Normally, those are headwinds for gold.
So what gives?
Well, two possible interpretations. One, maybe it was just a technical rebound. Gold had a pretty sharp sell-off on Tuesday, so maybe dip buyers just saw an opportunity.
Multiple.
Two, and perhaps more tied into today's main theme, it could be some safe haven demand kicking in, directly linked to those new Russia sanctions. Maybe gold is reflecting the heightened geopolitical risk that the equity market seems to be, well, actively ignoring for now.
Interesting. Okay, that brings us to the immediate future. Next week looks incredibly packed with events. Starting tomorrow, what's number one on the watch list?
Number one, without a doubt, is Friday's delayed CPI report. If that number comes in hotter than the 3.1% year-over-year expectation, that creates immediate uncertainty.
How would markets likely react?
It would seriously complicate the Fed's easing narrative and likely trigger a quick repricing in bonds, and probably stocks too, heading into next week's events.
And speaking of next week, it's a real cluster of critical global policy events, isn't it?
It really is. You've got the FOMC meeting concluding. You have Bank of Japan and ECB rate decisions, and then that high-stakes Trump-Xi summit on Wednesday, October 30th.
And the outcome of that summit is key for the trade outlook.
Absolutely crucial. It dictates the near-term trade trajectory. Do those threatened November 1st tariffs actually happen? Or do we get some kind of temporary truce extension, which seems to be what the market is currently pricing in or hoping for?
So if we try to put all these pieces together, the cautious trade optimism, the possibly temporary oil spike, the expectation for maybe inline inflation, what's the most likely scenario for markets over the next few weeks? The base case.
Well, our base case remains what we've been calling muddle-through volatility. We'd assign maybe a 45–50% probability to that right now.
And what does that entail?
It basically involves incremental news, not dramatic breakthroughs. So maybe you get a temporary extension of the trade truce, nothing permanent. CPI comes in roughly as expected, maybe 3.1% or 3.2%. And that oil spike starts to mean revert, maybe settles back into the $60–65 range as those workarounds for Russian exports start to materialize.
And what does that muddle-through environment mean for the major indices like the S&P 500?
It probably implies a choppy, range-bound market, not collapsing, but not breaking out either. We'd expect the S&P 500 to maybe trade somewhere between, say, 6,500 on the low ends and 6,850 on the high end. It's a market that's kind of defined by waiting.
Waiting for what?
Waiting for more clarity on the trade relationship, waiting for the Fed to actually deliver the cuts the market expects, and waiting for this oil market anomaly to settle down.
Okay. So as a final thought for our listeners today, we've covered the day's news, the credit market tightness. But if you wanted to point to one key structural pressure point, something systemic to keep an eye on beyond the daily headlines, what would that be?
Yeah, that's a good question. I'd say look beyond the public equity markets for a moment and really focus on commercial real estate, or CRE,
Siri, why specifically?
because that sector is flashing some major distress signals right now, particularly in the office segment. We're seeing national vacancy rates up above 19%. And delinquencies on commercial mortgage-backed securities, CMBS, they're now standing at 11.7%. Those are high numbers.
And why is that a systemic concern beyond just the building owners themselves?
It becomes systemic because of the sheer scale of the debt involved and what's coming due. There's a massive maturity wall looming.
How do they?
Around $950 billion in commercial real estate debt is set to mature in 2025 alone.
Wow, nearly $1 trillion.
Exactly. And the problem is, if these highly leveraged properties can't refinance at today's much higher interest rates, and many can't because their underlying values have fallen dramatically,
Okay.
they risk default.
And that spreads.
That distress then ripples outwards. It hits the regional banks, the specialized lenders who hold a lot of this debt. It creates this continuous, immense refinancing pressure that's going to be a key systemic factor to watch moving forward, really regardless of whether the Fed cuts rates next week or not. That underlying CRE pressure isn't going away quickly,
Something to definitely keep on the radar.
for sure.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.